Lesson 2: Budgeting and Financial Planning. Budgeting is a crucial aspect of personal finance that involves creating a detailed plan for allocating income towards expenses, savings, and investments. By developing a well-structured budget, individuals can gain better control over their finances, track spending habits, and work towards achieving their financial goals. Steps to creating a budget: determine your income, calculate your total monthly income, taking into account all sources such as salary, freelance work, rental income, dividends, and any other cash inflows. List your expenses. Itemize your expenses into fixed, for example, mortgage, rent, insurance, and variable, for example, groceries, entertainment, clothing, categories. Ensure that all recurring and irregular expenses are considered. Set financial goals. Establish short-term, medium-term, and long-term financial objectives, which may include eliminating debt, building an emergency fund, saving for a home, or planning for retirement. Allocate your income. Distribute your income among various expense categories and savings goals, prioritizing based on your financial objectives and requirements. Track your spending. Regularly monitor your spending to confirm that you are adhering to your budget and making necessary adjustments when needed. Review and adjust. Periodically evaluate your budget, assess your progress in achieving your financial goals, and make any required modifications to your spending and saving habits. A well-structured budget offers several advantages, including improved control over your finances by helping you make informed decisions about spending and saving. Identification of areas where you can reduce expenses or increase savings to allocate resources more effectively. Development of disciplined spending habits that can lead to long-term financial stability. Prioritization of financial goals, allowing you to focus on what matters most to you and allocate resources accordingly. Creation of an emergency fund to handle unexpected expenses and financial setbacks, reducing stress and providing a financial safety net. Enhanced understanding of your financial situation, enabling you to plan better for the future and work towards financial independence. By following the steps outlined in this detailed overview of budgeting and financial planning, individuals can develop a comprehensive understanding of their financial situation and make informed decisions about spending, saving, and investing. This knowledge serves as a foundation for achieving financial goals and maintaining long-term financial stability. 2.2 Savings and Investing. The importance of saving. Saving is the process of setting aside a portion of your income for future use. It is essential for achieving financial goals, building an emergency fund, and preparing for unexpected expenses. Saving also allows you to take advantage of investment opportunities and grow your wealth over time. Types of savings accounts. Regular savings account, a basic account that earns interest and offers easy access to your funds, with few restrictions on withdrawals. High-yield savings account, a savings account that typically offers higher interest rates than regular savings accounts, but may have more restrictions on withdrawals or require a higher minimum balance. Money market account, a type of account that combines features of both savings and checking accounts, offering higher interest rates than regular savings accounts and limited check writing capabilities. Investing is the process of allocating money to various assets, such as stocks, bonds, and real estate, with the expectation of generating a return over time. The primary goal of investing is to grow your wealth and achieve financial objectives, such as funding education, buying a home, or securing a comfortable retirement. Basic types of investments: stocks, shares of ownership in a company, which can generate returns through capital appreciation and dividends. Bonds, debt securities issued by corporations or governments that pay periodic interest and return the principal at maturity. Mutual funds, pooled investment vehicles that invest in a diversified portfolio of stocks, bonds, or other securities, managed by a professional investment manager. Exchange-traded funds, ETFs, investment funds that hold a basket of securities and trade on a stock exchange, offering diversification and lower costs compared to individual stock or bond investments. Real estate, physical property, such as residential or commercial buildings, that can generate income through rent or capital appreciation. The potential return on an investment is generally related to the level of risk associated with that investment. Higher risk investments tend to offer higher potential returns, but also carry a greater chance of loss. Diversification is a key strategy to manage risk, as it involves investing in a mix of assets that are not highly correlated, reducing the impact of any single investment's poor performance on the overall portfolio. Time horizon and risk tolerance. When developing an investment strategy, it's crucial to consider your time horizon, how long you plan to invest, and your risk tolerance, how comfortable you are with the possibility of losing money. Typically, a longer time horizon allows you to take on more risk in your investments, as you have more time to recover from potential losses. On the other hand, a shorter time horizon and a lower risk tolerance would generally call for a more conservative investment approach. Credit management and debt. Understanding debt. Debt is money borrowed by an individual, business, or government from a lender, typically in the form of a loan, credit card, or line of credit. Borrowers are obligated to repay the borrowed amount, along with any interest and fees, according to the agreed-upon terms. Types of debt. Types of debt. Secured debt is backed by collateral, such as a mortgage or auto loan. If the borrower defaults on the loan, the lender has the right to seize the collateral to recover their losses. Unsecured debt. Unsecured debt is not backed by collateral, making it riskier for the lender. Examples include credit card debt, student loans, and personal loans. A credit score is a numerical representation of an individual's creditworthiness, reflecting their likelihood of repaying borrowed money. Lenders use credit scores to assess the risk associated with extending credit, and borrowers with higher credit scores typically receive better terms, such as lower interest rates. Factors affecting credit scores. Factors affecting credit scores. Payment history. Consistently making timely payments has a positive impact on your credit score. Credit utilization. Maintaining a low credit utilization ratio, the percentage of available credit used, can improve your credit score. Length of credit history. Having a longer credit history with a mix of different types of credit accounts positively affects your credit score. New credit inquiries. Applying for multiple new credit accounts in a short period can negatively impact your credit score. Types of credit used. A diverse mix of credit types, such as installment loans and revolving credit, can contribute to a higher credit score. Strategies for managing debt. Strategies for managing debt. Develop a budget to track your spending and allocate funds towards debt repayment. Focus on paying off high-interest debt first, as it can accumulate faster and cost more over time. Consider consolidating multiple debts into a single loan, with a lower interest rate, which can simplify repayment and save money. Resist the temptation to take on new debt for non-essential purchases. Save money in an emergency fund to cover unexpected expenses, reducing the need to rely on debt. By understanding debt, credit scores, and effective strategies for managing debt, individuals can work towards reducing their debt burden and improving their overall financial health. This knowledge is essential for achieving long-term financial stability and reaching personal financial goals. Retirement planning and pensions. Retirement planning is the process of determining your financial goals and creating a strategy to achieve them by the time you retire. A well-structured retirement plan can ensure that you have sufficient income and financial security during your retirement years, allowing you to maintain your desired lifestyle without relying on employment income. Key components of retirement planning. Key components of retirement planning. Determine how much money you will need during retirement by considering factors such as your desired retirement age, life expectancy, living expenses, healthcare costs, and potential sources of income. Develop a disciplined saving and investing strategy to accumulate wealth over time, which may include contributing to retirement accounts, investing in stocks, bonds, or real estate, and building an emergency fund. Create a diversified investment portfolio that balances risk and reward by allocating assets across various investment types and sectors. Consider the tax implications of your retirement savings and investment strategies, and take advantage of tax-advantaged accounts, such as IRAs or 401ks, to minimize your tax burden. Establish a plan for the distribution of your assets after your death, which may include creating a will, setting up trusts, or designating beneficiaries for your accounts. Pensions and retirement income sources. Pensions and retirement income sources. Social Security is a government-sponsored program that provides retirement, disability, and survivor benefits to eligible individuals based on their earnings history and contributions to the program. These traditional pension plans provide a guaranteed monthly income during retirement, based on factors such as years of service and salary history. Employers typically manage and fund these plans. These plans, such as 401ks and 403bs, allow employees to contribute a portion of their salary to a retirement account, often with employer matching contributions. The retirement income depends on the account balance and investment performance. IRAs are tax-advantaged accounts that individuals can open and contribute to, independent of an employer-sponsored plan. There are two main types of IRAs: traditional IRAs, which offer tax-deductible contributions and tax-deferred growth, and Roth IRAs, which provide tax-free growth and withdrawals in retirement. Additional sources of retirement income may include rental income, dividends, annuities, or part-time employment. By understanding the importance of retirement planning and the various income sources available during retirement, individuals can develop a comprehensive strategy to ensure financial security and maintain their desired lifestyle throughout their retirement years. This knowledge is essential for achieving long-term financial stability and peace of mind. Risk management, insurance and healthcare. Understanding risk management. Risk management is the process of identifying, assessing, and addressing potential risks to minimize their negative impact on an individual's finances. Insurance, particularly health insurance, plays a critical role in risk management by providing financial protection against unforeseen events, such as illness or injury. Types of health insurance. Types of health insurance. Private health insurance is offered through insurance companies, employers, or other organizations. Plans may vary based on coverage levels, premiums, deductibles, and copayments. Public health insurance programs, such as Medicare and Medicaid, are government-sponsored and provide coverage for specific groups of people, including seniors, low-income individuals, and those with disabilities. Many employers offer health insurance as a benefit to their employees, often sharing the cost of premiums. Employer-sponsored plans typically offer a range of coverage options, including medical, dental, and vision insurance. These tax-advantaged accounts allow individuals to set aside money for medical expenses. HSAs are typically paired with high-deductible health plans, while FSAs are offered by employers as a supplemental benefit. Importance of health insurance. Importance of health insurance. Health insurance can help cover the cost of medical expenses, including doctor visits, hospital stays, prescription medications, and preventive care, preventing financial strain or bankruptcy due to medical bills. Having health insurance can provide access to a network of healthcare providers and specialists, ensuring timely and appropriate care. Many health insurance plans cover preventive services, such as vaccinations and screenings, to help maintain overall health and detect potential issues early. Other types of insurance for risk management. Life insurance provides financial protection for an individual's dependents in the event of their death, covering funeral expenses, outstanding debts, and providing income replacement. Disability insurance offers income replacement if an individual becomes unable to work due to illness or injury, ensuring financial stability during the period of disability. Long-term care insurance covers the cost of services such as in-home care, assisted living, or nursing home care, which may be necessary as individuals age or become unable to care for themselves. By understanding the role of insurance, particularly health insurance, in risk management, individuals can make informed decisions about the coverage they need to protect themselves and their families from the financial impact of unforeseen events. This knowledge is essential for maintaining financial stability and peace of mind throughout life.